Most private equity funds aim to exit or monetize their investments within a 5-year holding period in order to provide timely returns to their limited partners. Let's go through some of the key exit strategies private equity firms can employ to realize returns. Returns are typically realized via a sale to another company, commonly referred to as a strategic sale, a sale to another private equity fund, or an IPO. Private equity funds may also extract a return prior to exit through a dividend recapitalization. The ultimate decision regarding when to monetize an investment, however, depends on the performance of the target as well as prevailing market conditions. In some cases, such as when the target has performed particularly well or market conditions are favorable, the exit or monetization may occur within a year or two. Alternatively, the private equity fund may be forced to hold an investment longer than desired as dictated by company performance or the market. By the end of the investment horizon, ideally the P fund has increased the target's EBITDA. Can be through organic growth, acquisitions, and/or increased profitability, and reduced its debt, thereby substantially increasing the target's equity value. The P fund also seeks to achieve multiple expansion upon exit. There are several strategies aimed at achieving a higher exit multiple, including an increase in the target's size and scale, meaningful operational improvements, a repositioning of the business toward more highly valued industry segments, an acceleration of the target's organic growth rate and/or profitability, and the accurate timing of a cyclical sector or economic upturn. Let's go through each of the primary LBO exit strategies for private equity firms. Trade sale. Traditionally, P funds have sought to sell portfolio companies to strategic buyers, who typically represent the strongest potential bidder, due to their ability to realize synergies from the target and therefore pay a higher price. The proliferation of private equity funds, however, made exits via a sale to another fund increasingly commonplace during the mid-2000s. Moreover, during the strong debt financing markets of this time period, P funds were able to use high leverage levels and generous debt terms to support purchase prices competitive with those offered by strategic buyers. Initial public offering. In an IPO exit, the P fund sells a portion of its shares in the target to the public. Post-IPO, the fund typically retains the largest single equity stake in the target with the understanding that a full exit will come through future follow-on equity offerings or an eventual sale of the company. Therefore, as opposed to an outright sale, an IPO generally does not afford the P fund full upfront monetization. At the same time, the IPO provides the P firm with a liquid market for its remaining equity investment while also preserving the opportunity to share in any future upside potential, depending on equity capital market conditions. An IPO may offer a compelling valuation premium to an outright sale. Dividend recapitalization. While not a true exit strategy, a dividend recapitalization provides the P fund with a viable option for monetizing a sizable portion of its investment prior to exit. In a dividend recap, the target raises proceeds through the issuance of additional debt to pay shareholders a dividend. The incremental indebtedness may be issued in the form of an add-on to the target's existing credit facilities and/or bonds, as part of a complete refinancing of the existing capital structure. A dividend recap provides the P fund with the added benefit of retaining 100% of its existing ownership position in the target, thus preserving the ability to share in any future upside potential, and the option to pursue a sale or IPO at a future date. Depending on the size of the dividend, the P fund may be able to recoup all of or more than its initial equity investment.